rate for the bank. And could you give a sense of the debate and the range of views on the committee as to where the terminal rate would be? And just another follow-up on the budget. For you, again, personally, would it have been quite a closer call for you now in terms of cutting rates immediately if you didn't have the advantage of waiting until the budget had been held before and getting that on board before moving?
Well, let me take that question first, and I'll come back to the question on terminal rates. I think there's a very important point which I think you'll pick up not only in my paragraph, but actually other paragraphs, which is, and I mentioned it in my opening remarks, we've had one inflation number which came in under our projection. That's obviously very welcome. I think it does suggest, as I said in my comments earlier, that we've reached the peak. But my own view is, and I think colleagues share this in some measure, that of course we really do need to see more than one number to establish that is sort of in the picture, as it were. So I will be looking very carefully at, as I just said, at the data that we will get before the December meeting. That will be a very important consideration for me. So yes, we will have a new fiscal policy by that stage to condition on, but really importantly, we will also have more numbers. And I'd emphasise that because we always have more new numbers, obviously. But the point is that we are at quite an important moment here because we've had one set of inflation numbers, which I think can give us some encouragement, can point us in a direction, but we need to see more than that. Coming back, your question on the first of all, I think all of us chose our words very carefully. For me, the market curve at the moment does give a reasonable view of a sensible path. By the way, that's not always the case. I mean, sometimes we've sat in this room and not been quite at that place, so I can't guarantee you that will always be our view. On the terminal rate question, I think it's probably quite clear also from comments, not only in this set of minutes, but in other comments the committee, as members of the committee have made, in speeches they've made. I mean, we do divide somewhat into two camps. I don't want to overdraw it. There are those who I think who do take a view that, they do take a view on R* and on the so-called, if you call that the terminal rate. There are those, and I'm in this group, who don't actually, frankly, feel that there is enough confidence around any measure of an equilibrium terminal rate, and that when we look at this question of restrictiveness, we're looking much more at the evidence on the sort of the change over time, as it were, in the path of restrictiveness, rather than looking at the terminal rate. But anyway, Claire may...
Yeah, happy to. We've set out quite a bit, actually, in the report in the risk sector. There's a chart 3.4 that shows you all the different ways that we look at this. I mean, our analysis is policy is still restrictive. There's, as Andrew says, a difference of views. So much members have sort of raised this in their paragraphs about it. I mean, it's quite, determining how restrictive you are and issues around terminal rate, obviously quite complicated. It's quite challenging. It sort of gets more challenging as you lower rates, right? Yeah. So, we've sort of said that. But there's quite a lot of material in here that we've shown on this, and as Andrew says, the individual powers, I think, also give you a bit of a sense of how different people look at it. There is a difference of view, both about what the, debates and discussions around what the levels may be, but also around these more sort of philosophical questions about, actually how do you know, how do you try and work it out, how important it is to you in thinking about your policy, and again, you can see that in the difference of views here, with it being a bigger issue for some people than for others.
The only thing I was going to add, because again, as part of what we've done today with, I'd agree with Andrew. This is a milestone in terms of responding to the Bernanke review. Is that we are trying to be as open as we can about, for example, the various risks. So one is this point about just how restrictive is the monetary policy stance. I mean, just to reinforce something Claire just said, one thing that we've added this time, as rather than just repeat the mantras about that there's a range of views on restrictiveness, is that some of us do put more weight than others on these quantitative estimates. But there is something in the minutes in para 12 where we say that, as bank rate approaches neutral, the contribution of monetary policy to underlying disinflation would become harder to discern, making the case for further policy easing more finely balanced. So this notion that, because we've been able to reduce the degree of restrictiveness, we would all agree that we're getting closer to the neutral rate or the terminal rate. So, that gives you some sense also that the debate and the way we're thinking about this is inevitably going to evolve and change in the future.
Darshini, and then Halia, please.
Thank you. Darshini David, BBC News. Another budget one, I'm afraid, but in terms of last year's budget, because the MPC have been increasingly clear in your reports in recent months about the role that measures such as the increase in national insurance, national living wage, have played in increasing price pressures and wage pressures. To what extent has that contributed to hesitancy over the last year when it comes to the cutting of interest rates? And if I may too, you've highlighted the risks in the stock markets in recent weeks and months, in particular when it comes to AI stocks. Now, those concerns have gathered pace somewhat over the last few weeks. Can you give us an update on your thinking there?
Sure. I'll repeat something I know I've said before, but I think it's important and I can sort of update it a little bit. Of course, for us, the big question was how would the change in national insurance contributions pass through? What was going to be the transmission of it? It's something we spend a lot of time on. When I go around the country, I'm afraid it's the first question that businesses get from me usually, which is, can you explain to me how you've responded to it? And we've set out in the past, there are a number of channels working through sort of margins, employment, wage settlements, investment to improve productivity. That takes rather longer, and obviously prices. I think I've said before, in the early days, obviously, and they're not mutually exclusive, by the way, there was a sort of tendency to tick all boxes. I think over time, I would say that the two labour market stories have probably come a bit more to the front of the responses we get. So I say, people who are not, employment has reduced. Now, by the way, I think that comes more through not hiring than, we're not seeing much of a pickup in redundancy measures, for instance, but I think it comes more through the channel of not hiring. And I think some others then say, well, actually, no, our wage settlement was lower than it would otherwise have been. That, by the way, is also affected by the interaction with the national living wage, because if you've got more people around the national living wage, that channel is not as open as it would be if you haven't. So that's a relevant consideration. So I think we've picked up some more of that, as I would certainly say so. On the stock market AI question, I just say one thing about this. It obviously is something that we look at very carefully, and you'll be hearing, but we're going to do it. The next thing we'll produce is the next financial policy report. So, you'll be hearing more about that on the financial stability report. The one thing I would say is this, because I think I've read a number of articles that have questioned this. It is, of course, perfectly possible and perfectly consistent that AI could be the next big mover in terms of productivity. So it could be the next general purpose technology. My own view personally is I think, more likely than not it probably is, but we've still got quite a way to go to actually sort of see that demonstrated. At the same time, we could have a bubble, because obviously the markets are pricing the future stream of returns from this, and that's uncertain. And so, those two things are not inconsistent. The markets could overprice the returns, but the returns could still be substantial. So we'll see. But we are watching obviously the implications for financial stability, and then the pass-through that could happen into the broader economy, such as covered here in the monetary policy report. We, of course, will watch that very carefully.
And just to reinforce that point on the reason we've also flagged this risk in the monetary policy report is because were that bubble to deflate or burst, that would represent a tightening in financial conditions, that would weaken global demand, and that would have spillovers back to the UK. So it is relevant to us on the MPC as well as the FPC.
Halia, in the middle there, and then Phil Aldrich.
Halia Ibrahimi, Channel 4 News. You haven't cut interest rates today, and clearly, Governor, you are the deciding factor. How do you explain wait and see to families at home who are struggling with mortgages and loans if you say inflation has passed its peak?
Well, I want to see more evidence that it's passed its peak. I hope it, I believe it has, but frankly, as I said before, in response to the earlier question, we've only seen one number so far. So I want to see more evidence. That's why, I've made very clear, you can see it in quite a bit of the commentary, including my own paragraph, that this is an important factor. Now, I think, I think the best way I can put it is, I think these two big risks that I was talking about earlier have, in my view, become more balanced since we were last sitting here in August. I think that's the way to put it. But the best thing we can do for families, as you say, is get inflation back to the 2% target. That's not only the best thing we can do, it's the thing we must do. And therefore, I'm encouraged that we've seen this one number, but I do want to see more of it.
And inflation is at 3.8%.
Yeah.
So, that's a long way above the target. We're forecasting it will come back to 2%, and that's conditioned on the market curve. But 3.8 is quite a long way above 2.
We'll go to Phil here and then Joel at the back.
Thank you. It's Phil Aldrich at Bloomberg. There were two scenarios in the report today. I just wondered why one of those scenarios wasn't a fiscal scenario, given that the most immediate issue on the horizon is the budget, which it seems very clear that there's going to be consolidation at that point, and what that might mean for your reaction function. And just on, you mentioned regulated prices. The Chancellor is looking at, or supposedly looking at regulated prices. If she took action on that, would you welcome it?
I'll get Claire to come in on the scenario. Just on your points about regulated prices, can I go back to something? It's a totally fair question, Phil. Can I go back to something I said in my opening remarks? I mean, the important thing, of course, is what we see in terms of regulated price increases next year. Because obviously, sorry to state the blindingly obvious, but inflation is an annual calculation. So, we have these things called base effects where the effects drop out. The question, of course, is what comes next, and that will be very important. And I think that is a point that has been, taken by the government. I think you can see this from some of the things they've said. And I think if you go back to the point I think Darshini was making about what the Chancellor has said, I do think that it is a point the government has taken about the impact that these things can have on inflation and therefore on policy setting, and that's important. I'll hand over to Claire on the scenarios.
Yeah, and actually just on that, you can see the impact at the moment, the 3.8 number we're talking about. We think about 0.4 of that is these sorts of administered prices at the moment. I mean, on the scenarios, we've chosen these quite clearly based on the fact that they are the biggest issues in thinking about inflation and setting monetary policy to get it back to the 2% target. So, there is this question about how do we think about this balance across the economy of the risk that inflation proves to be more persistent for various reasons, whether that's structural change because it's been higher for a longer period, could be all sorts of issues. So that's one scenario that we have to think about and take very seriously and explore. On the other side, there is this sort of weaker demand scenario, which could come, potentially through the labour market or could come through what we're seeing in consumption, where again we've seen consumption being weaker than we've expected for quite a period of time. So we've selected the scenarios based on the fact that they are the most relevant things for the policy committee in thinking about inflation. And as you can see from the way in which different members have set that out, that framework is one that everyone's sort of consistently using and puts different balances on those two sort of forces, as Andrew described them, in terms of what's driving inflation.
Do either of those reflect the potential fiscal outlook from the budget?
So what we've done on the assumptions we raised, as Andrew said, what we do is we condition all of our work on the announced fiscal policy as it stands now. So that's the fiscal stance that was set out at the last budget.
Joel and then Philip.
Joel Hills, ITV News. Governor, ITV viewers will take the view that strong pay growth is rather a good thing. Thank you very much. Could you just explain to them why the bank takes a different view? And also, your Deputy Governor said in a speech in May that she thought a sustainable rate of pay growth is around 3% or potentially a bit higher. How confident are you we will get there in the next few months?
Well, I'll take the first part, and then Claire may want to come in on the second part, because we have quite a few deputy governors, but I think it was actually Claire you're talking about here. So, Look, pay growth, as we say in almost I think in every report, and I was saying earlier, obviously is an important determinant of inflation. It feeds through. That said, of course, one also would expect a relationship between realised inflation and wage bargaining going forwards. And that's why we put a lot of emphasis, as I've mentioned earlier, on the question of inflation expectations and how those pass through. Now, obviously inflation has come down substantially from where it was 3 years ago. And we've seen wage settlements adjust down over time. But the emphasis that we've put over in almost every report since then on the question of persistence is all about the question of to what extent there will be continuing effects, this potential effect working through things like expectations. So we will continue to look at it very carefully. What I would say is that we have been through a period where pay settlements were well above the level that all of our models were suggesting they would be. I think that may well be related to some evidence that we've had, over that period of time, a negative shock in terms of labour supply. There's a lot of questions about how we measure it at the moment and the uncertainty around the data. What I would say is the evidence, pay settlements are coming down. We seem to be likely to hit towards the end of this year around about the level that our agents in the survey they did at the beginning of this year sort of thought they would be. So they do seem to be tracking downwards, but that will, and where they go, henceforth will obviously continue as always to be an important part of our considerations.
Yeah, let me pick up, because that isn't quite what I said. What I did was I set out a set of basically ready reckoners on what sort of level of wages would be consistent with the inflation target, depending on what you assume about productivity and what you assume about import prices. Actually, most of those estimates were higher than 3%. I mean, wage growth is obviously something that we look at really carefully. It's 4.4% at the moment. That is higher than a target consistent number. We expect it to be coming down. It's one of the bits of evidence that we're going to be looking at very closely. I mean, as it is in our current forecast, we do have it at 3% towards the end of the forecast, consistent with the target. But it depends on what you assume about all these different variables. And that's what I was talking through, just actually how do these ready reckoners work and what do you think about import prices and productivity and how that affects.
And what do you assume currently? What's a sustainable rate of pay growth?
Well, as I say, in the forecast that we have at the moment, towards the end of the forecast, it comes down to 3%, and that is where we also have inflation at 2% at that point. But as I say, that depends on a number of assumptions that are underpinning that forecast, and of course we have some different scenarios that we've also looked at. So it's a good example of why you want to look at a whole range of things. We have quite a lot of discussion of this in the report. Because of it's important to us in terms of these underlying drivers of inflation.
And it's worth saying that a key underlying assumption that means that 3%, which is what we're forecasting for Q2 2027, would be consistent also with inflation returning to our target, is that there will be some productivity growth, around about, I think, probably moving up towards 1% or so. But that's the that's how you can kind of make those two things consistent. But there's uncertainty around productivity, and it is absolutely critical that there should be some productivity growth.
There's also uncertainty about import inflation at the moment as well. So it's not as straightforward as you might hope.
Philip, and then Sue.
Hi, Philip Inman from The Guardian. I wanted to take a slightly different tack, which is to look forward to next year when you have a forecast for growth slowing, you have unemployment rising, and yet wouldn't it be reasonable for the public to think that you were more accommodative than you are planning to be? You still have restrictive interest rates next year when the economy is quite clearly suffering under your scenario before it recovers in 27 and 28. Why do you still hold that? Wouldn't the public think that it's reasonable for you to cut rates faster in that scenario?
Well, in terms of judging the restrictiveness of policy, I think it comes back to the answer I gave to Sam's question earlier, actually, which is as we look forwards, this question about how restrictive policy will be at any given point in time. In my read of it, I always say, look, it depends on how the change in monetary conditions evolves. I don't have a view on the terminal rate. I don't fall into that school, frankly, because as I said earlier, I think just to be technical for a moment, the standard errors around those two estimates are just too big. So what that means in practice is that every time we meet, we have to rejudge this question in the sense as to how restrictive is policy, and that's got quite interesting over time. I mean, I'd give you the most obvious element of this question, which is mortgages, because the mortgage market in this country has changed fundamentally in the last 15 years. It's gone from being a variable rate market to a fixed rate market. That means that actually the transmission of monetary policy takes longer, comes through more slowly, comes through in parts, because obviously it depends on the balance of the mortgages that people have. And so we have to keep coming back to this question as well, and this is a point I think Dave was making, to financial market conditions and rejudging this restrictiveness question. And as I think you can tell from the individual paragraphs, there are different views on the committee about just how restrictive policy is at the moment. So some of my colleagues would I think push back at you and say they don't think policy is particularly restrictive at the moment. I think that it is still restrictive, but as we said, as Claire was saying earlier, and I would agree, the degree of restriction is reducing, which sort of is consistent with cutting, obviously, and we will have to judge that question going forwards about how restrictive it continues to be meeting by meeting.
Can I add a point on growth, which I think is quite important, which is from an inflation perspective, it depends what's driving the weak growth that really matters, and you can't necessarily assume that because growth is a bit weaker, and actually, we do have growth sort of strengthening through the period in our, it's, it rises a little bit towards the end, but it's really important to think that, depends what's driving the weak growth and whether that is about the level of demand in the economy or the level of supply, and that has very different impacts for inflation. So it's one of the ways we have to sort of think about this. You can't necessarily assume that weakness in activity is going to necessarily reduce inflationary pressure.
That's right. I mean, I've said in a number of speeches I've given recently that I think the biggest challenge we have in this country, and by the way, we're not alone. I mean, we're in company here, is that the potential growth rate has fallen over the last 15 to 20 years.
Sue and then John Paul.
Hi, Sue Chan at The Telegraph. Just following up on questions from Darshini and I think Phil, just stepping back a bit and looking at the last year, would you say government policy on things like the minimum wage, the national insurance increase, packaging taxes have helped or hindered your fight against inflation? And in general, are government interventions to bear down on prices welcome, or should policymakers stick to their knitting to allow you to stick to yours?
Well, it's interesting. I think we first, in a sense, drew attention to what we tend to call this hump in inflation in the February inflation report, so 9 months ago, I'm talking about. And actually, when we look back at the February monetary policy report and sort of the shape of that hump, it's a point Dave's made to me a number of times, he's nodding, it looks actually rather like it does today. We've had a few changes in between in what we thought might happen, but it's actually looks right. And one of the reasons is that, as Claire was saying earlier, part of that is these so-called administered prices. Now, they do have an impact, and so it is something that we've drawn attention to. And I think the second thing is that the pass-through of national insurance has not been that different to what we were expecting at the time. So those two things have more or less transmitted. Now, in terms of, it's for government to decide its own policies, because government has all sorts of other public policy objectives. I mean, we're one public policy objective, and I use public policy broadly there, obviously, as a term. And there are many other public policy objectives. So give you an example, in the administered price regime, part of that is water bills. Well, fixing the water system is a public policy objective. It's not Bank of England's public policy objective, but it would not be for the Bank of England to go around saying, no attention should be paid to fixing the water system. That would not be, I think, a very sensible thing. So we have to take account of these. I think we do have to draw attention to the effects of these, which we do, obviously. and then factor them into our outlook.
John Paul and then Anna.
Hello, John Paul Ford-Rockcast from the Daily Mail. Couple of things, please, Governor.
Could you talk about, I'm sorry, the acoustics in here are sometimes quite variable depending on where you're sitting. If you could talk a little bit, it would be really helpful.
Yes, sorry. John Paul Ford-Rockcast from the Daily Mail. A couple of things, please. First of all, households are worried about income tax going up, perhaps in the order of tens of billions of pounds. How much relief or reassurance can you give them that were that to happen in the order of that, all else being equal, that would provide an impulse to the bank to cut interest rates in December? Secondly, with your regulatory hat on, with car finance and the compensation scheme that's currently proposed by the FCA, you're the regulator also for banks. Banks are suggesting it would be disastrous and damage the economy. The FCA pushing back on that. Do you have a view on that issue, please?
Well, the income tax question, I'm afraid I'm going to give the same answer. It's really, of course, it's obviously for the government to decide what the budget's going to be. The Chancellor will announce it, and we will take it into account. The economic modelling for the budget, of course, is done by the OBR, not by us, and that's important. So, we will assess what is announced by the Chancellor in our next round, and that's the right way to do it. So we're not giving a message on fiscal policy today because we'll wait and see what fiscal policy is. On car finance, look, when we do the next event in here, it will be, as I said earlier, the financial stability report. We will also be publishing the bank stress test. I think I'm right in saying that. Yeah, we will. And so we obviously have taken all that into consideration for that. So you can look forward to that. I think it's next month, early next month. Don't hold your breath though for all the month long. I wouldn't advise that. Literally, that is.
Anna and then Ryan.
Hi, Anna Wise from Press Association. You say you're concerned about the high level of household saving. Can you explain what's driving this? Is it a long-term shift in behaviour, and how much are you having to take that into account?
Yeah, I'll get Claire to come in. Of course, when we say concerned, I mean, it is what it is. We're very interested to assess. Your question's a very good one, actually, as to why it is, because that's relevant to our outlook.
Yeah, sure, happy to. And as Andrew says, when we say we're concerned about it, it's one of the factors that is feeding through in our judgment on the level of demand in the economy and therefore inflation. Obviously, it's for households to choose how they want to behave. I mean, in terms of, we've spent quite a lot of time looking into this because consumption is such a big part of the UK economy that it's a really important driver of what we expect to happen. And in fact, we've got quite a detailed box on this in the report. It's unclear. We've done a huge amount of sort of investigating into it. So some things are quite obvious, right? So interest rates are higher. That obviously incentivises savings and that drives some of the behaviour. There may be some sort of what we call precautionary motives. And if you ask households why they're saving more, they do point to those sorts of things, not necessarily around the labour market, but in general more a response to sort of uncertainty and risks. The other thing that we've had a bit of a look at is this question of are people trying to sort of rebuild their wealth following some shocks. So it could be a combination of things. We've looked at it in quite a lot of detail. It is one of the big drivers, and you see it come out in what a lot of members saying about the risks as they see around the economy. So it's something that we're really focused on. As I say, consumption being over 60% of the economy, it's a big driver of demand.
And just to add to that, we've actually tried to quantify in the downside scenario what would happen if savings doesn't fall back, which is what we've got in our central projection. For, as Claire was saying, those precautionary reasons. So if you think about the mechanism is savings staying higher, and then we've quantified the impact of that on consumption and GDP. So again, we're trying to sort of not just describe the risks, but also give a sense of what that alternative future might be with the downside scenario, which some members put more weight on than others then in how they vote.
Ryan, who's just there, and then Ritika right behind him.
Thank you. Ryan Saby from The Sun. What's your message to households when it comes to food inflation, especially with global and domestic cost increases, sees that those prices remain elevated? How can you explain that outlook for the next year, 18 months or so?
Well, again, I think in this story that, you know, we've had this hump in inflation over the course of this year, food is another, as we set out, is another component of that. It's about another 0.4, isn't it? I think, something like that. And we thought, and I think we said this probably last time, that probably the peak would be around about sort of the later part of this year. Again, you know, tentatively that looks like it is the case, which is obviously good and helpful. The components of that, as we said before, a bit of a mixture. So there's an element of global commodity prices. It's not spread across the board. It's quite concentrated in a few commodities. You know, coffee is one of them, for instance. There's some labour costs, undoubtedly, in there. And our contacts do mention the packaging tax, you know, as well. That's another element of it. So there's several components of it. The other thing, and I think I mentioned this earlier in my remarks, interestingly, our staff has actually given us some interesting analysis on this. There's a lot of analysis that says food is particularly salient in the inflation basket for the obvious reason that, in a sense, we all buy it very frequently. I was going to say every week or whenever, but I mean very frequently. So we tend to sort of, in our mental map, we can carry around the cost of food more than, say, a flat screen TV, which, well, I only speak for myself, I don't buy very often. So, you know, it is salient. Now, so therefore, there's a sort of, you know, there's a reasonably well-established view that actually, therefore, in terms of forming inflation expectations, these things will weigh more heavily. Our staff have actually presented some interesting analysis to us suggesting that may not be the case. So, you know, jury's out a bit on that one. But look, it's really, obviously, to your question, really good question, it's really important, obviously, for people, because food is such an important part of the consumption basket. And can I say more so, because for those on lower incomes, food and energy, of course, are an even bigger part because they're the essentials of life. It is important that food inflation comes down.
Ritika's just there, and then Maurizio.
Ritika Gupta, CNBC. Governor, given the MPC sees a slack opening up in the economy, you've outlined weakening demand or weakening labour market, do you ultimately think that interest rates are going to have to go below neutral in order to close a negative output gap?
Well, I'll bring Claire in. I think there's two parts to this I'd emphasise. One is, what is the level of slack? The second is, how does that any given level of slack influence wage and price formation? It tends to be called the Phillips curve relationship, as we tend to call it. And those two things are both highly relevant. I don't know what you want to...
Yeah, I mean, sort of not necessarily is the point. I mean, look, to come back to this point that we have inflation at the moment that is 3.8, is higher than it should be, and it's, you know, we're quite far from a target consistent level. So the slack is unfortunately needed to bring inflation back to target. It's not necessarily needed. If you know, it doesn't necessarily mean that interest rates have to go below the neutral level, because we think we have some now. It's a very uncertain. It's a very sort of hard thing to judge, and you know, we spent a lot of time thinking about it. But we do think there's slack in the economy now, and that will sort of widen slightly.
Maurizio, and then Joel at the back.
Hi, Maurizio Allen Carr from City. Just wonder, with this decision today and the minutes in your report, what message you're sending to markets and to business confidence? Is holding interest rates going to weigh down on business confidence, given, you know, expectations of fiscal restraint at the budget and, you know, a lot of other sort of geopolitical uncertainty at the moment? Thanks.
Well, can I? Yeah, it's a really good point. So let's try and boil it down a bit. We talked about sort of two sort of risks that we have. One is that higher inflation becomes embedded more, and the other one, and on the other side, is going back to the previous question actually, is that we get this weaker demand story coming through. Going back to the earlier question that, as Dave was saying, that consumption doesn't correct, saving rate doesn't correct. And those two things, are what we're sort of steering between. Now, I think those two risks have become more balanced than when we were sitting here. They were, in my assessment, when we were sitting here in August the last time we were sitting here. I do think we're now in a more balanced position. And I just use again the phrase that I used in my opening remarks. I think rates are on a gradual downward path, but the judgment about when and by how much is going to be very conditioned by how we see this balance of forces going on.
Joel at the back.
Thank you. Joel Suss, Financial Times. I want to just come back to the terminal rates. So in this NPR, you've added simple policy rules as a way to illustrate how bank rates should evolve under the central projection in different scenarios. But of course, the simple policy rules require an estimate of the neutral rate, which you've set as 3%. So I just wonder how we should read that, especially in relation to the market rate of 3.5%, your own stated position of 3.5% seeming right at this point in time. Is 3% the default or average view of the committee? Should the committee be plugging in different estimates of the neutral rate? Thank you.
There isn't an average view because, as I said earlier, some members put more weight on estimating a terminal rate than others.
Yeah, look, let me pick this up. I mean, really pleased that that people have sort of spotted this policy rules material. I think it's a good innovation, and it's something where we're trying to be a bit more transparent about the sorts of information that we look at as a committee. I wouldn't take from it anything about, we're giving any sort of steer or indication about neutral rates. There's a very lively debate across the committee on this. What these rules are really useful for is helping you think through, how you think about policy, looking forward, what are the things that drive you. In some cases, you might think some rules are more appropriate if, for example, you think that the forecast at 12, 18 months is a pretty, is a good indication. You might put a bit more weight on the forward-looking rules. If you think actually some of these equilibrium variables are a bit more uncertain, you might be more interested in your first difference. So the idea really is we're showing you the sorts of things that we look at because they're part of the debate that we have. We're not trying to either directly or indirectly send any signal about this much broader question of neutral rates, where we also discuss that very directly in the report when we look at all the different ways you can look at it and what that might be.
The only thing I'd add is that, this is an issue we faced in the way we've, I think, quite rightly taken the report. Obviously, with the central projection, we condition on the market path. Once we introduce scenarios, if we condition the scenarios on the market path, we'd be really suffering an apples and oranges problem. You'd rightly say to us, hang on a minute, that doesn't really work. So we face, well, what are we going to condition on? And I think using rules in the way we have, not using a rule, as Claire said, but more than one, but not too many, is the sensible way to do that. Not because we follow them, but because they're sensible sort of conditioning assumptions, and they give you a sense as to how we think about them.
Michael, and